Buying an investment property in the UK. In this video, we're going to explain the different taxes you need to know about so that you can get the most out of your investment. Hey there, James here from Phoenix Advisors, where we make business simple. On this channel, we share advice and tips to help you grow your business and maximize results. If you're new here, be sure to subscribe to keep up to date with our weekly releases. Today, we're going to be discussing two of my favorite subjects, property and taxes. Property taxes can be extremely complicated, but today, we're going to break it down into three simple phases: the acquisition, the period of ownership, and the selling phase. At the end of this video, I'll also be sharing some top tips for your property business and letting you know where you can get hold of our free guide. So make sure you stick around to see that. When you buy a property in the UK, you will have to pay stamp duty, or stamp duty land tax as it is sometimes referred to. This is in addition to any legal fees, estate agent fees, and the purchase price of the property. Luckily, stamp duty is a one-off tax that you only pay when you buy the property. There are several variables that affect the amount of stamp duty that you have to pay. But broadly speaking, it depends on the value of the property and whether or not this is your first home, as shown on screen now. These rates are correct at the time of filming, but may change in the future. Before buying, be sure to check the HMRC website to find out the latest rates of stamp duty. Investors looking to grow their property portfolio by owning more than one property will also have to pay an additional 3% stamp duty on purchases. Although this may appear unattractive from the very start, rental property is a long-term game. The future benefits should far outweigh the initial costs. So that's it. Congratulations, you now own your first investment property. We hope that you're getting value from this video so far. If so, please do smash the thumbs up button and leave a comment below. So you now own your property. Great. Assuming you've made a good investment and you've managed to rent the property out, the money should start rolling in. But unfortunately, you need to pay some of that money to the government. The government will collect their share via taxes. What taxes you have to pay will depend on how you have structured your investment. We'll be posting a video shortly on different structures, their advantages and disadvantages, so make sure you keep an eye out for that. If you buy the property as an individual, you will have to pay income tax on those rental profits. How much income tax you pay will depend on the level of rental profits and the level of other income in that tax year. Income tax rates are currently set at 20%, 40% and 45% depending on your level of earnings. If, however, you buy the property through a UK limited company, the company pays tax on any rental profits. The company does not pay income tax, it pays corporation tax instead. So what's the difference between income tax and corporation tax? Well, corporation tax is significantly lower at a flat rate of only 19%. That's 19% as compared with 20%, 40% or 45%. So surely everyone should buy their investment property through a UK limited company. Well, as always, the answer is, it depends. The problem is that technically the property and any income from that property belong to the company and not to you. In order to benefit from the rental profits, you will have to take those profits out of the company. When you take money out of the company, that income is subject to income tax. One major benefit of using a UK limited company is that you have far more options for extracting the money out of the company. Set up correctly and in the right circumstances, this can greatly reduce your tax liability. It is therefore extremely important to seek professional tax advice before making your investment. Please do get in touch if you need any help here. As a property tax advisor and an investor in rental property myself, I take great pride in helping others set up their portfolio to maximise results. So you've had this property for a while now, and for whatever reason you want to sell it. Guess what? That's right, tax. This time, capital gains tax. Capital gains tax is only payable when you sell the property. So if you want a free bit of advice on how you can avoid paying capital gains tax, it's very simple. Don't sell your property. Again, how much tax you will have to pay will depend on a whole number of variables, not limited to the profit on sale and whether or not you're selling this as an individual or as a limited company. Individuals pay capital gains tax at 18 and 28% on profits from the sale of residential properties. They also have a small annual tax-free allowance each year. Companies pay corporation tax on any gains instead of paying capital gains tax. Corporation tax being 19%, as we saw previously. One downside of a company here is that a company does not benefit from the annual allowance that individuals do. This means that you'll be paying tax on a slightly higher profit. The other downside? Well, you've sold the property for a great price and you've got your money. But as we said earlier, that money technically belongs to the company, not to you. But that money is only beneficial to you if you can take the money out of the company. And guess what? As with before, you will pay income tax when you take the money out of the company. This can be an extremely taxing phase, but don't let this put you off. If you seek good tax advice throughout your investment, the advantages should greatly outweigh the taxes that you will have to pay at this final stage. In some specific cases, it is possible to avoid some of these taxes and retain more wealth for yourself. It is easy to sound as if I'm selling my own services here, and in part, I am. But I cannot stress this point enough. Any great investment that is to flourish must be rooted to sound and proper advice. The small cost of an advisor today is often far cheaper than the big tax bill later. My first top tip is to keep all records relating to the property in a neat and tidy order. This may sound simple, but it is so important. This is supposed to be a fun and simple business. There is no fun in searching all over your home, trying to dig out expenses relating to the previous year. Moreover, if you cannot find the expense, often you can't claim it. That means you end up paying more tax than you're supposed to and keeping less money for yourself. Decide how you're going to keep your files, whether physically or electronically. If saving them electronically, make sure you name them appropriately so that you can find them in future. Also, make sure that you have a backup. Remember, a backup is not a backup until it's been tested. The added benefit of this is that if all your records are stored in an easy to follow way, your accountant will probably spend less time working out your taxes. This may result in him or her charging a lower fee. My second top tip is to consider how the investment will be financed. This is one of the most important factors of any investment, but one that is often overlooked. Are you going to finance the property yourself? Are you going to use debt from a bank or other finance provider? If so, how much will they lend you? Furthermore, will they allow the use of a UK limited company? These are all really important questions to ask before you even start looking at properties. This is a common pitfall we hear about a lot, where people spend time and money finding their dream investment, only to find out that the bank will not lend them the money that they need. Likewise, it is pointless setting up a new company if your finance provider will not allow the use of one. Finally, there are a whole load of additional options available to you when you use debt that can significantly reduce your tax bills. But your tax advisor may only be able to help if you consult them before diving in. Got everything that you need? I hope so, but in case you haven't, I have a free guide for you in the description box below. Be sure to download your copy, and don't forget, you can always come back and replay this video later. I hope that you found this video helpful. If so, please hit the thumbs up button below and share this with your friends so as many people can benefit as possible. If you have any questions, leave a comment below or visit our website phoenixadvisors.uk. I will also leave a link to that in the description. That's it for today, but don't forget to subscribe and click the bell icon to be notified of our future releases. We will have another edition coming your way next week.